Hello everyone and welcome to the IndexUniverse Spotlight Series. My name is Ugo Egbunike and I'll be your host for today's show. Today I'm joined by Andrew Chanin, the CEO and co-founder of PureFunds ETFs. Thanks for joining me, Andrew.
Thanks for having me, Ugo.
So go into the kernel or the idea that brought about PureFund ETFs and a little bit about the funds that you've brought to market recently.
Certainly. So as having a history and background as a market maker and prop trader in exchange traded funds, my partners and I had noticed that there was a lack of certain types of funds, specifically natural resource based ETFs that were on the market. So when we got together, we decided to come up with our top list of ideas for funds that weren't currently on the market that we wanted to launch. So with that idea came about our first 3 ETFs. We have the world's first mining service ETF, ticker MSXX, that tracks the mining service industry, so companies that sell equipment, lease equipment, or provide services to the producers. Our second fund is the Diamond Gemstone ETF, and it's a life cycle play of diamonds and gemstones. And our third fund is our Junior Silver ETF, which brings about companies from all over the globe that produce on small scale or explore for silver.
So let's go into the Diamond ETF a little bit because that's one of the first I've seen that actually tries to provide that pure exposure. I know there was recently a filing by Van Eck as well, but go into sort of the idea behind that and what sort of exposure you're targeting with regards to the portfolio management and how you're doing that.
Right, so with this fund, what we noticed was an opportunity to launch a way for investors to gain access to the diamond gemstone space that wasn't currently there outside of just investing in individual names. So being that diamonds have this aura of being a life cycle, a life type of commodity that a diamond is forever, obviously, what we wanted to do was give the full life cycle play to our ETF. So what we did was, working with the International Securities Exchange, they developed an index for us that comprised companies that did everything from exploring and producing diamonds to holding large inventories to going out and actually selling the rough and polished stone through retail. And we also see some of these companies that are vertically integrated across those different spectrums. So being that diamonds aren't as that fungible of a commodity as some of the other types of resource funds, we thought it was important to actually have an equity play, so the companies that are doing this, as opposed to something that varies on a case-by-case, diamond by diamond, gemstone by gemstone type of basis. So by comprising a basket full of companies in this space, we thought that we'd be able to bring investors a new way to invest into this space while having exposure to the diamond and gemstone industries.
Now there's no diamond spot price, for instance, for us to reference, is there? But
there are different people that come out with prices based on where sales have been over a long period of time, but there's no futures market for it. Yes. So that's something that even as an investor makes it a very difficult thing to hedge against. So what we're doing is we realize that it's such a veiled type of industry that not everyone has that ability to go out and purchase an investment grade quality type of stone. But this was a way for investors to get the exposure to the companies that are using diamonds and gemstones to build their revenues.
Great. So you also have your junior and silver miners ETFs. There's a couple more competitors in that space, and I know, unfortunately, that looking at that space, you guys are about 69 basis points for an annual expense ratio, which is about 4 bips more than the other players. So for our viewers out there, give the case as to what's unique with these funds as opposed to sort of the iShares silver miners and the sort of Global X silver miners play, and why they should be looking at the PureFunds ETFs and paying up a little bit more.
Sure. So across all of our funds, we actually maintain the 69 basis point management fee. And throughout this, what we've noticed is in the gold space, you had gold mining ETFs, and then later through that process came the junior and the explorer types of plays to this. We noticed that in the silver industry, you have your physical and futures funds, and you had your major producers, but there wasn't necessarily a junior explorer silver specific play to this. So we wanted to be the first one out there giving this pure silver exposure to this market. So although our management fee is slightly higher than the other silver mining plays in the space, there wasn't a silver ETF out there that was really going after these junior types and explorer types of plays. So this is for someone that does have a higher risk portfolio. It's viewed as a beta play, so as silver prices go up, this is generally has correlated to the spot prices, but tend to be more volatile, even more so than your majors. So these companies have more assets in the ground that have yet to have been produced and are on the smaller production scale compared to the other funds that are out there that have more major names. And like our other funds, it's also a global basket of companies.
So you talked a little bit about how these funds would be targeted towards those seeking a little bit more risk, and investors tend to forget that there is risk in actually accessing a lot of newly launched ETFs with regards to the trading. Talk a little bit about how, from the perspective of an issuer, you've tried to sort of enhance the liquidity available in your funds.
Right. So when you talk about liquidity of ETFs, you actually have two different types of investors that this can relate to. So on your on your institutional side of investing, you tend to have people with larger amounts of money that they can invest into these funds. Now, for investors such as an institutional investor, they have the ability to actually go in and create the fund, as opposed to just going in and buying shares on the open market that your smaller investor would typically do. What that means is that someone that actually was interested in purchasing, say, 50,000 shares or a multiple of that of a fund can actually go and contact an authorized participant and have that created on their behalf, where they would actually have a set price for most cases of what price that would be executed at. So although you might not necessarily see the liquidity on the books for that type of investor, they're actually able to go out and execute trades with a price already in mind. For a smaller or retail investor, what they might see as an option would be putting in limit orders. Like you said, volumes might not be as high as some of the more established funds already, but what you do have is the ability to put a limit order in to get executed at your price if there is a transaction to be done there. So as opposed to doing a market order that could increase the price to wherever you see offers that are currently laid out on the trade book, a limit order might be one that is a safer order for someone like that.
Great. And then for those institutional investors that might want to deal with APs or authorized participants, do they call you up? Do they establish that relationship with somebody else? What's the sort of process for that?
Many people do have these relationships already set up, but it's something where we would love to help make introductions for people that are looking to do these larger units if they don't already have pre-existing relationships.
Great, great. And one more thing. So I noticed in reading the prospectus for your funds that there is a specific clause that explicitly excludes the ability to rehypothecate and hypothecate the underlying securities in the fund, what most people know as securities lending. Can you speak a little bit to that and why your group chose to do that? I know that most issuers actually benefit and most shareholders benefit from securities lending, but give us an idea of what the thought process was when you guys included that clause within the prospectus.
I'm glad that you've done your research and noticed that. That's something that, as PureFunds, we had a background in trading ETFs, and what we wanted to do when we were building our ETFs was to take all types of investors, not just the larger investors and market makers into mind, but we wanted to take every single investor's different ideals and perspectives into mind when creating these funds. And one of the things that we thought was important was a proactive stance that we took. And just like you mentioned, we wanted to remove some of this securities lending, hypothecation, rehypothecation risk. And essentially what happens in some funds is the actual underlying securities that are being held by the custodian are in fact lent out to a certain amount to other participants in the market. Now, what you see here is that these stocks can then actually not just be lent out once, but they can be lent out several times over. So not only do you, as an investor, have a counterparty risk to these people that are lending these securities, but there's also a risk that they've lent it out to someone that has an even larger type of counterparty risk given their credit rating or other factors such as that. Now, we wanted to go out and we wanted to protect these underlying assets from that practice. So although you said many issuers do actually benefit from this practice because they're actually able to raise money from lending the securities, it's another risk that is in the prospectus and is adding to the riskiness of that investment, and one that typical investors don't usually think about. But in a type of situation where there are different counterparties that are becoming even riskier, that's something that your underlying investor wouldn't have any control over for most cases.
And you believe that as far as portfolio tracking is concerned, because I do know that most issuers and fund investors alike benefit from portfolio tracking as a result of securities lending processes. Do you believe that you guys still have that capability to track the index tightly without that process being in place?
When we came forward with our funds, and as it's even clearly expressed in the prospectus of the funds, what we promise to do is to best track that index with given fees and expenses. And one thing that we didn't want to have in there was that we'll also try to outperform whatever we're able to perform by adding in this increased risk in order to meet a perfect tracking. So in most passive management, it is very difficult to track an index specifically due to the fees that would be coming out from any typical type of transaction that you have with a passively managed fund. So we haven't made representations that we will be using types of things like securities lending to help meet up that shortfall. So given our sub-advisor that actually does the portfolio management, that's something that he takes into consideration, but there isn't this extra income coming off that other funds would have to increase that value to perfectly track your tracking error.
That's all the time we have for today. Andrew, thank you for joining me.
Thank you for having me, Ugo.
Folks, PureFunds is the name of the company. For more information, visit www.pureetfs.com. That's all the time we have for today. I'm your host, Ugo Egbunike. Thanks for tuning in, and tune in next time.